Hi there, and welcome to the Closing Bell on the 17th of September. Sorry about the audio, it's a bit flinty. I am in the city at the moment at our office and don't have my usual setup at home. So apologies for that straight off the bat. But tell you what, the markets are getting pretty interesting, aren't they? All the things we've been discussing for quite a while now of what the risks are out there. We're getting very close to a time when markets could really surprise just how volatile they can get. We have the US 10-year bonds I've been talking about really on the edge of that 3.5% level, which is the highest yield that they've been at for 12 years. It's a threat to the whole downtrend really from the last 30 odd years. What happens as yields break out above there? It's a real tinderbox situation, I think, especially when you look at other markets out there. Commodities getting hit pretty hard. Just last night, and it's Friday afternoon when I'm recording this, we had commodities across the board down around 3 to 4%. Oil hit pretty hard. Gold, I've been showing you the 1675 level in the US dollar gold price. If it heads below there, I've been showing you that there's a chance it could really start to free fall. Well, gold is now really at that level. It's again, when you look across markets and they're all set up in a bit of a tinderbox situation, you know that it won't take much for it all to set fire and for some pretty big moves to occur. Also, the S&P 500, that has turned down sharply, hasn't it? With those inflation figures, the music stopped very quickly. Market has woken up to itself that this is not over yet. I've been showing you that we're in long-term downtrend, and while we're in long-term downtrend, you take the rallies with a bit of a grain of salt, and you're a bit wary of sticking your nose above the parapet too quickly. So let's have a look at all of those markets very quickly, just to give you a sense that it is a pretty interesting time. And hopefully through these videos, you are feeling a bit prepared for what may be about to occur. So just looking at the US 10-year bonds, I showed you this last week. Just want to really drive that point home. This is going back to 2012. This is the yield on the 10-year bonds. So you can see that the move from what, 0.5% yield on the 10-year bonds, which is a pretty crazy level. That's right at the height of the crash in 2020. That would not be a pretty good investment if you'd been buying those bonds at that level. So with yields going up, that's the price of those bonds going down. So that is a huge sell-off that we've had over the last few years. We've been tracking it higher as it's occurred. And really it's looking at the monthly chart will give you the sense, but I just wanted to look at this weekly chart to show you the way that we've had this fall from around 3.5% recently. And then that was when we had that bear market rally, bonds were rallying and stocks rallying. And look at this, it has certainly switched that off. And now we're flirting with the top of that whole level. Sorry about that drawing, that was pretty hopeless. But breaking out above there, you just don't know. Look, maybe it's going to get to a point and then turn back down. Sure, if that happens, then we can start getting a bit more bullish again. But while it's sniffing around this level, if it does break out, does it cause more forced sales of those bonds? And do we see a spike higher in yields, which would really feed into weakness in stocks? So US bonds set up pretty neatly for some bad times. Moving on to the gold price, and we've had a bad night last night. Again, we've been tracking this sell-off over the last few months. I've shown you this before, but it just gives you a sense of what's going on. This is huge rally from 1919 to 20. We've gone into a corrective phase. There's the low of the correction there. Since then, I've been giving you my analysis based on the midpoint of that correction, being the point of control. That was around 1880. And you can see we've had lots of work done moving back to the point of control over and over, moves into the buy zone of that area and back to the point of control, happening over and over, up into the sell zone, back to the point of control. So this is sort of how it works while it's correcting, that point of control being like a magnet. And now we can see that we've had an attempted rally over the last few months out of that buy zone, but the selling has returned and it's now breaking down below the low of the correction. So the question is, how far can it fall here? And the way this works is you've got to be thinking about the people who are buying in this period, 21 to 22, that's a year's worth of buying, nearly 2 years worth of buying. Are there stop losses set up here? Usually that's the case. So there could be a year's or two's worth of stop losses somewhere down here, and often it can feed into itself where stoppies set off other stoppies, and you can have a bit of a disastrous move, but that could end up setting itself up for a move back higher. It just depends how far it needs to fall before the real buying pressure emerges. And if rates really do spike higher through 3.5%, well, you could make a case that gold could surprise to the downside for a bit at the moment. So yes, be a little bit wary of those gold stocks. But yeah, longer term, I think you're setting itself up for possibly a real long-term buy on those gold stocks. And just a quick look at oil. This is West Texas Intermediate, and we've seen this again. This is a monthly chart. We've been analysing this 1999 to 2008 rally, looking at the same thing again, the point of control coming in around 80 bucks on that, and that's been for decades. We've had lots of moves out of that buy zone into the sell zone, back to the point of control, again, buy zone, point of control, and we had that crash, which went to zero, and but another move back to the point of control, up into the sell zone, and here we are with that move heading back to the point of control again. So you want to watch oil down around this $80 level. This is where you'd expect there to be good support, and apparently the US saying they're going to start buying oil again to restock after they lowered their strategic supplies around that 80 buck level. So that could end up providing quite good support. I think long term, there is a case to be made that oil will be stronger for longer. So this sell-off should be setting up a buying opportunity. But yeah, you do have to watch how prices behave around this sort of $80 level, because if it does bust down through, let's say 70 bucks, you are looking at potential a move back down to that buy zone. So it really is important that there is some support coming in around that sort of 70 to 80 buck region, let's call it, in the short term. But you are getting signs that global growth is slowing, commodities are coming off, copper's starting to get hit again, nickel, etc. Even rare earths, lithium looking a little bit toppy to me, but that is the one that everyone is on. There's no doubt about that. If that starts coming off, that'll be interesting. But it's just there's signs out there. Things are slowing down. So let's move on to the most important chart, that S&P 500. We again have been watching this for a while. The long-term trend, this is a monthly chart going back to the start of the rally in 2009. We've had a very strong long-term uptrend. It's turned down finally. And we've been talking about this the last few months, this bear market rally going up into stiff resistance. So I just want to go in there, have a quick look at this one. It was what was going to happen on this bear market rally. What was going to happen around that 20-month moving average and 10-month exponential moving average. If the selling pressure was there, you had to watch out, because once things turn back down, back below that low, we're starting to look pretty scary. So it really is shaping up that it wants to do that and it feels like the market's not that far from even accelerating to the downside. So let's just have a look at a weekly chart. And you can see on this weekly chart, we had a few weeks ago, you know, I've been showing you how these things develop. We were looking at the ranges, the point of control, the false break of either edge of that range in direction of trend, and then watch out once you get the sell pivot, and off we go to the downside. And we had the similar setup, didn't we, just recently, which I was showing you when markets were at the highs, looking at the correction against the trend. And you're looking at the point of control of that midpoint, and you're looking at the false breaks of either edge of that range with prices going back to the point of control. And then we had that false break at the top. You can see there, and then here we go, weekly sell pivot, false break, watch out. And now it's back down through the point of control of that and looking pretty sketchy, I have to say. So from here, yeah, is there going to be a lot of support to the bottom of that range? That will be the question. Does it start getting a little bit panicky as people wonder what's going to happen below there? So you'd want the buying support to come in before we hit that low. If it can do that, find a bit of buying support, you know, then we've got another few months of stuffing around. But then it can still end up turning down. Pretty much everything at the moment saying watch out there. It's been trying to hold in there. We've had these periods of the bear market rallies coming in and slowing down the market from falling. But that goes on for a while, and then it gets to a point when no longer are people trying to buy the sell-offs, and people start panicking and saying, get me out. And all of a sudden, things can accelerate to the downside far more than you ever thought possible. So looking at this overall, I'm just looking at that whole rally since 2020 and saying, where can this thing fall to? We're looking at that buy zone down there of that whole range. So you're saying 2,600, 2,800. I think ultimately, if it breaks below the low of the correction and below the point of control of that whole range, you have valid reasons to think that the S&P could be heading towards 2,600 or 2,800. So that would get pretty scary. So yeah, I guess it's saying that after those CPI figures, you've got to be wary out there, and let's see whether there is any support around at the moment, and whether things do accelerate to the downside. Gold looking certainly scary, and other commodities coming off. It's certainly a time to be thinking about capital preservation rather than where is the next buying opportunity. All right, well, I think that's enough for this week. I shall come back with more next week. Cheers.